You know, it was Albert Einstein who said the most powerful equation in mathematics is the exponential function. In finance and investments, we know that as the equation you use for compounding interest. And as any beginning student in business, finance, investments, accounting knows or should know, that if you started with $1 or any other currency for that matter, and you got 10% on it, well, you'd get $1.10, and then it would compound $1.21, $1.33, and a tenth of a penny, and so on. And as an aside, in those olden days, way before my time, they used to use straight line interest, which means by year 5, instead of getting that $1.61, we'll ignore the rounding, that you would only got $1.50. And you can see why this compounding, this exponential return is so important. And of course, this is found in the exponential function, raising something to some power. And we will note that the percentages are done in decimals. And we can solve backwards by not only raising to something to some power in the future, but given a future value of wealth here, that we can take the ratio and take the root of that power, subtract 1 for the principal, and get back that return across that period. And while we look at some traditional financial examples in just a moment, let's start with my favorite, comic books. Yes, we have the Spider-Man and the Superman. The Spider-Man, the original issue sold for 20 cents. Some 40 years later sold for $4,000. Pretty good. The Superman first action comic sold for $0.10. That was back in the late 30s. Sold a couple of years ago for $10 million. Interestingly, they both had almost the same annual compounded rate of return of 27%. And you might not think that's too realistic, except for a couple of years, like last year and around 1999. But you know what? A more relevant example, a less risky example, that's equivalent to most credit card rates. And you're saying, what? Yes, look, we have 18% after tax for most people in high income tax brackets. 27%, let's say you have a third federal and state income tax bracket, and, well, that's 18% after tax. Or the taxable equivalent is 18%. Now, dividing by that 1 minus a third is equivalent to a 27% rate of return. And, of course, in the case of paying off your credit card, that's always certain, as opposed to the stock market. In strong contrast to a comic book, at the other extreme in this financial example is an OID, an original issue discount bond. It's a bond that does not pay interest. The tax law requires that you pay taxes yearly on the annual imputed gain on that non-interest bearing bond. In this example, it's a nominal 10% yield, but in a 40% bracket. So after tax, that should be 6%. And you see the amount of the increase yearly. You see the taxable portion, the 40%. And then if you discount this at what? That after-tax rate, that's 6%. That's 10% nominally after 40% tax. You find that the present value of the tax payments, that's an outgo, minus the present value of the gain at 6%, is exactly equivalent to the nominal value that we began with at an after-tax discount rate of 6%. So everything matches. And for those of you so inclined, I know, bless your little hearts, here's a mathematical proof for you. And the takeaway here is that you want to think of everything on an after-tax basis because that's the world we live in. And you might say, well, then why don't we just give the information on an after-tax basis? And, of course, that's not appropriate because different people are in different states or in a different state of having a different income tax bracket. And indeed, there is many a publication, especially for mutual funds, where they will give you the state and then give you the bracket, and then they'll print a little chart showing you what the after-tax effect is to you given those parameters. And of course, one might say, well, gee, this is all very nice and theoretical, but again, look at that. Whether it's a comic book or paying off your credit cards, it really makes a profound difference with Dr. C Invests.